I'm here this afternoon with Ed Koral and Mark Millard from BDO's Risk Insurance and Advisory Practice. And I wanted to catch up with Ed and Mark to talk a little bit about one of the hot topics that I'm hearing a lot about from my clients in the risk management community, who are telling me that they are feeling a lot of pressure these days to find ways to cut costs in their department and with their insurance programs. Their companies are under a lot of pressure right now. Revenues are way down. Costs are, constant. And I thought I would catch up with you guys to just get your thoughts on how you think risk managers can impact their organizations and find some savings for their organizations. So with that said, Mark and Ed, maybe you can talk a little bit about, what are the key things that risk managers can look at as they're looking to reduce their costs?
No, thanks, Mike, and thanks first for having us on your initial video cast for the client. So I think that's great. So thanks for having us. So we're thinking about this, Mike, in a three-pronged approach. We're thinking about this for the issues that have already occurred, so the claims that have already occurred today, connected to the crisis. We're thinking about this for the current situation you find yourself in for your insurance programs and your overall program structure. And then we're thinking about this in terms of what is coming in the near term with preparing for insurance renewals. And so if we break those into three parts in terms of that thought process, the first process is for what has occurred. And this is what you see everyone talking about in media right now. And what most of media is saying is that there is limited to no coverage for business interruption claims, for property claims, because there's been no property damage, because there's virus exclusions and there's ISO exclusions that are on your property policies that are strictly stopping any claim from happening in the first place. So you're seeing a lot of press on this topic saying you do not have insurance coverage for this. And so what we think is missing from that conversation, though, is the other factors that are coming in from the environment. And the other factors that I think about are one, not every insurance policy is created equal. Two, there is currently litigation in play, and there's bound to be more litigation that is going to be pressing these issues and further, I think, creating other avenues of recovery and different possibilities. And there is currently regulatory and legislative pressures that are also coming to the insurance markets. And then we also start to think about it more broadly, that it's not just property and business interruption, that those are the only discussions we should be having, but we need to be thinking about directors and officers liability insurance. We need to be thinking about workers' compensation, general liability, and umbrella for third-party bodily injury and property damage. Those are other coverages that are that I think potentially is going to be missed in this discussion if someone's not proactively having that. And so if we take D&O for a second, part of the things that we're seeing, what we're hearing in the marketplace right now in directors and officers insurance, is that in the upcoming renewals, you are going to have exclusions on your D&O policy very specific to COVID-19 or virus or something that is going to be all-encompassing to limit these types of claims. And so you have some risk right now. The risk right now is if you have a claim where the occurrence date so as we know, a D&O policy is a claims-made policy, meaning that the claim has to be made within the policy period or it is not covered. It's not like an occurrence form where you can, as long as a claim occurred during a policy period but is made years later, it's still covered in that policy period. So for those D&O instances, if the wrongful act occurred during the policy period, but is not then reported or noticed to that insurer until after the policy period, there is no coverage for it. And so what clients need to be thoughtful of is if there are certain things that are happening in this moment that are giving rise to claims, that they're notifying their insurance companies before these exclusions start to get tacked onto them, or that they're figuring out some alternative measure that they're going to have this covered long term, and whether that's some type of hybrid tail policy that they buy to connect this coverage in or something like that. But we need to be, I think, to summarize that, be broadening the conversation beyond property and BI, looking at these other coverages that we have potential recovery for, and exploring these things as they are all very fact specific, your insurance policy specific, and no one size fits all.
So in other words, if I, can paraphrase this, it wouldn't be fair to be so quick to just simply say, well, there's no coverage for this because there's an exclusion for COVID-19 or for issues like this. There's a lot more to it. And there are a number of different ways to find coverage where you think there may not be any. Would that be correct?
No, that's exactly right. I mean, Mike, in the commercial marketplace, coverage can be highly negotiated, and there are plenty of manuscript policies out there that do not have all the standard forms and endorsements. So it's critical that you look at these policies. And one word, coverage can really sometimes hang on one word. And whether the word is there or the word is not there, and people looking at their policies and then having some expert help there, whether that's coverage counsel or someone else, to say, do we have a recovery potential for this specific set of circumstances?
Fair enough. So, outside of looking for coverage and really analyzing policies and things like that, that really covers what you already have in place for things that have occurred already, correct?
Right.
So now, looking at it from a more proactive standpoint, what can risk managers do to help ease the burden going forward?
Well, and thanks again, Mike, for having me on today. One thing what I would add to what Mark said is you just need to think about this. Think about how all the different people were affected by the COVID-19 situation, how they're affected by it, and what different possible ways they can shake the tree to find money. And you have to put your own mind inside of that, because people who are terminated from their jobs might be looking to file lawsuits against their former employers for wrongful termination. It can come at you from so many different angles. And understanding what the potential angles are so you can at least anticipate them is very important. But that wasn't your question. Your question was, what can you do now to try to get some money out of your program? And I think there are some very basic blocking and tackling things that you can do to try to at least reduce the cost of the insurance that you're buying right now for a business that has probably, to a large extent, shrunken or diminished as a result of the crisis. So if you think about the underwriting data that went into your policy, it's very likely that you overestimated everything. If the business came to a standstill for a month or two, it's very likely that your estimates on payroll, on headcount, on sales, business interruption values, if your business is not operating right now, all of those things were probably overstated, not intentionally, but that's what ended up happening. And so the question is, can you go back to your insurance company and renegotiate the underlying exposure estimates that were part and parcel of your policy when it was first issued? Because if you can show that the exposure is going to be weighed down, this is an opportunity for you to get possibly an early audit of your policy, possibly a canceled rewrite, or certainly some type of renegotiation where everybody acknowledges that you've now overpaid on the premium because you've overestimated the exposures that the insurance company was insuring. I think that a lot of people would agree that if lots of people didn't come to work and the payroll wasn't there, you shouldn't be paying insurance premiums for it. And so that represents something that will help you try to pull cash out of the policies and the programs right now. Then as we move into the kind of present and near future, we can start to think about, is there a way of buying insurance capacity in a slightly smarter or more efficient way? Not to imply that it's not smart the way you're buying it now, but when you're buying excess limits, is there a way that some of your programs can share insurance capacity? So that might mean taking your D&O program and making it a multiple coverage program where you've got D&O and fiduciary and crime, employment practices. You might have them all sharing one single excess limit. You might even consider looking to the insurance industry to give you a multiple year policy on the logic that buying 3 individual 1-year policies will probably cost more than buying a single 3-year policy. So things like that, just turning over everything to see if you can pull money out of the program without having a material effect on the quality of the coverage you've got. And finally, the market, as we've pointed out, the market was already getting pretty restrictive before this thing happened. So if you were thinking about becoming more aggressive or in retaining risk, keep that thinking going and possibly get more ahead of yourself and become more aggressive in how you retain risk in the organization. It's probably overdue.
All good points. All good points. I guess I was wondering, as you were talking about multi-year policies, as you're looking at a hard market right now, locking in hard market rates for multi-year sounds a little scary to me. But I guess if you can average it out, there's a lot of give and take with how you structure things to try and figure out the best deal.
That's a good point, and this locking in the buying high and selling low doesn't seem like a great idea. On the other hand, if you're trying to make what you can get last as long as you can, it could end up being thinking of it a different way. You can think of it as you're taking something that's become very expensive and you're trying to make it stretch as long as you possibly can, given what you've got to pay.
Right.
And Mike, and even to that point, I think what we're seeing in the clients that are doing multi-year policies is while, certain clients that we've talked to in this current environment are seeing renewal increases anywhere from 100, 150, and 200 without exaggeration percent. And so what we're seeing, though, is not then another 100 or 200 tacked onto it for next year. We're seeing under 10% more maybe tacked onto it for next year in those scenarios. And then I don't think what any of us expect is that if I did that this year, then what I missed out on next year was a 40% decrease because all of a sudden the insurance market priced everything 40%, 50% lower than it did this year. I don't think that's what we expect to see. I think you could see a flattening out, maybe slight decreases, but I don't think you're missing out on 40% decreases next year by going into a multi-year policy.
Yeah, no, that's a great point. So then you basically average out, your 100%, 100+% increase this year. And if you average it out with next year, then it looks like a smart deal.
Yeah. Excellent.
So, Ed, I'm curious, how do captives come into play with this? It's a hard market. I'm sure people must have been thinking about, what they can do about that. Are captives something that people should be looking at?
Well, I'm one of those people who will tell you that captives are something you should always be looking at. But I'll try to answer your question. Captives are frequently thought of as kind of a hard market thing because the market got very difficult, prices went up, and then people formed captives. I think that there's kind of an intermediate step, and that is that what's not happening is people are saying, oh gosh, instead of buying commercial insurance, I will just put the risk in a captive. That's not usually what happens. What usually happens is the market gets very expensive. People find themselves taking a lot more risk because it's just part of the business plan that made sense. Is they needed to take more risk. And suddenly just taking deductibles and taking retentions became a much more significant undertaking. Suddenly you've got some very significant retentions and you're taking a lot of risk. And then you need to think hard about, well, how am I going to manage this? I can't just keep taking risk. Maybe there's a way of making that risk retention decision more efficient and more commercial than it has been in the past. The other thing I would say about the hard market is that if you're buying in that hard market, you're basically faced with retailers, and that's it. You're people who are selling insurance that are standardized retail products. If you own a captive and you can get your parent risk into the captive, then suddenly you're facing a much wider universe of people willing to take risk from your hands. So number one, you now are facing the reinsurance market, but also you can customize your own products. You can combine two different risks together by aggregate stop basket programs. So there's a much wider variety of transaction that you can enter into if you own a captive than if you're just buying insurance from brokers. And in a hard market, you're looking for every possible angle you can find to buy risk transfer from the marketplace. So that's why I think it's a great time to start thinking about captives.
So this is really irrespective of the virus situation that we're in the middle of here. This is really just speaking to, that you're in a hard market situation and what's a smart way to manage your insurance from that perspective.
Yeah, that's right. I think that we were in a hard market and people were beginning to think about captives a lot more seriously because of the hard market. The COVID virus thing is going to make the hard market a lot worse, and it means people will need to think even more about captives than they were before. Great.
All right. Well, to me, what I wanted to accomplish with this conversation was a quick hit on what risk managers can be thinking about and how they can bring some money back to their organizations and manage their costs more efficiently. I think we covered all of that. Is there anything else you think we missed in this conversation from that standpoint?
Just want to make sure you're washing your hands, Mike.
Excellent. Well, good point. I think I will, as soon as we're done with this, I'll go wash my hands just to make sure. And I appreciate your time very much. If anyone wants to get in touch with Mark or Ed and get more information, their contact information will be with this post below. And certainly, if you want to talk about recruiting and coming up with a more efficient staff model, I'd be happy to talk to you about that myself. And of course, my contact information will also be below. And thanks very much for your time. And we'll do this again on future topics. And certainly, if you have any other topics that you'd like to hear about, would love to hear from you, either in the comments below, or you can send me a direct message. And we'll be back at it in no time at all. Thanks very much.
Thanks, Mike.
Thanks, Mike.